Yeah, hi everyone. Uh, thanks for joining. I think we can start now. So, welcome to Gifted Insights, where we discuss investment related topics for NRIs and resident Indians. And yeah, previously we have covered a lot of topics around how to invest in India and globally, especially via Gift City. So today we have a very special guest, Varun, with us, who is the head of international sales for Edelweiss. So he's an expert in global investing. So just a quick introduction about myself. A lot of you already know me. If you have attended any of these webinars previously. So I'm Ankur, co-founder of Belong, which is an NRI focused savings and investment app, and I have over 15 years of experience in financial markets now in different avatars, starting with being a portfolio manager, then an algo trader, and then a fintech entrepreneur. And yeah, today we have, as I said, we have with us Varun, who's the head of international sales at Edelweiss, and brings with him more than 2 decades of experience, especially around global investing. Previously, he was with JP Morgan and PineBridge, and today he's going to talk about one of his favorite topics, which is China growth story. So we have all heard about India growth story. He's going to take us through the China growth story and why it's interesting. It's an interesting time to invest in China or look at China. So the way we will do this is we'll request Varun to take us through his presentation, and we can pause in between to take some questions. You can put your questions in the chat, or we can take them towards the end. We would like to keep it as interactive as possible. So feel free to drop in your questions, and I'll try and get them answered in between as well. So yeah, over to you, Varun. Welcome to Gifted Insights, and great to have you here.
Hi, Ankur. Good afternoon, everyone from India. And if you're logging on from other parts of the world, wherever you are, what time zone it is, hi. My name is Varun Sanan, and as Ankur introduced, I've got over 2 decades of investing experience. So let's start with the most basic question, around China. Why look at China? Now, think about it. A lot of us have portfolios which have stocks or companies that are, or even funds that are dedicated to India and US. Most of our allocation is within these two geographies of India and US. But think about it, which is the world's second largest economy? It is China, which is one of the most leading in terms of innovation, in terms of global growth and global consumption. It is China. And it'll be not fair to your portfolio if you do not have allocation to China. But before that, even from a diversification standpoint, you will see, and I've put my screen for you to make sense of some of those charts that will be coming up. But the first chart on your screen, and a very busy one, but I will try and make it a little easier for you, is about diversification. Now, what you see is that across years, there are different markets, and these are calendar years on top. And the best performing market is right on top. So in 2015, it was Japan with 9.9% returns. And in 2024, it's Taiwan, which gave out about 35% returns. And then this year, it's China. But what you will clearly notice is that across calendar years, the winners change. Most calendar years, what happens is a fund that does very, very well will probably go down a little, and then, maintain reversion to mean will happen. But interestingly, China is in a very different phase of growth. China is in a very different phase of how you have to look at China. Because what's happening is some of the most innovative companies now are actually not only in the US, they're also in China. And if you have missed the rally of buying into stocks like Apple, Google, Nvidia now, I think the second take would come from China. And that's why China is very, very interesting to have in your portfolio, not just from a diversification standpoint, but also from an absolute growth perspective standpoint. But given that, China's gone through a cycle of a big turmoil over the last 5, 6 years. We saw a big boom in Chinese equity markets and the Chinese economy. And then what did we see? We saw three things that actually happened in China over the last 3, 4 years. The first one was COVID. China was where COVID originated from, and actually it ended in China, so to speak. China did not vaccinate its people. It was the last country to come out of COVID because they did not go in for vaccination. They actually went in for herd immunity, which is let everybody get COVID, which is not the right way, but that is what China did. They locked down their cities, people got COVID, and then they built immunity, and then that is how COVID got cleared out from China. The second big thing that happened was when Donald Trump came in. We saw the reemergence of the 2018 trade war, where the Trump administration said China's been getting things very easy thus far, and we need to put tariffs on Chinese goods that are being sent into the US. And what that did was that put a lot of Chinese businesses into a frenzy to rethink and recalibrate their stance on how they want to go and do business. And they've come up from there as well. And finally, what China clearly showed was that they also have this big tech prowess, which we saw from the US in the last decade. So you saw, OpenAI as the biggest GPT or the most sought after GPT uh, come out of the US. But what DeepSeek showed us was they could actually come up with something that is equivalent on a very open architecture and at a fraction of the cost. So what that clearly tells you is the kind of tech work that's happening in China is just a matter of time that some of these companies will become global companies, and most of them have actually become global companies, and we will figure that out as we progress through this session. So, that is what had actually happened in China. But there are a few other things that have happened. So the first one is uh, if you take a look at, and if you're investors in equity markets, if you take a look around the world, equity markets, everything has done well. Everything has done exceptionally well over the last 4 or 5 years. The US tech stocks, the US market has done very, very well. India has done exceedingly well. Last 3 years, returns in India are upwards of 25%. Bitcoin has done phenomenal. And the last leg of the rally, gold and silver, they didn't want to be left far behind, and see what's happening with silver. The only place which looks cheap to invest right now of meaningful relevance is China. And that is why when we, as investors, you look at something called as valuation, which basically means if you're buying something expensive or if you're buying something cheap. Let me give you an example. If you are buying silver today, silver has doubled in the last 1 year. Are you buying it cheap or are you buying it expensive? The answer probably is you are probably buying it in that expensive zone. Can it go higher from here? Who knows? Most definitely it can go higher from here. But if it falls, it will fall quite a lot. And the risk reward is probably not completely in your favor. It might be tad bit in your favor, but not completely in your favor that you can buy silver and forget it for the next 4 or 5 years. Probably that strategy is not a great strategy. China, on the other hand, is cheap, is very, very, very cheap, and is probably the cheapest market globally. And on your right hand side of your screen, what you will see is look at this current number, this purple dot with different markets. And what you will see is China is one of the cheapest markets in the world. But comparing it to the Chinese average itself, it's at that same average which it was almost about 15 years back, lower than that, in fact. So you're getting into something that is exceedingly cheap. Cheap always does not mean good. But cheap means great if there is an underlying growth story to it. If you were buying a stock, a Tesla, at a value which was 5 years prior, and you had that entire growth of Tesla or Nvidia in front, that means you're getting something cheap and there is return to be made. And that we think is the play in China. Why do we think that is the question that we will try and answer right now. So the big shifts that are happening in China, two, three very, very clear shifts that are happening in China. Chinese GDP. So if you understand GDP, and for people who don't, I'll try and explain it, make it simple for you to understand. GDP is nothing but the investments that the government and the private sector makes, the exports that happen, and the consumption that people like you and me, if we are Indian citizens, do, or if you're a global citizen, whatever you consume in that. So the population, what they consume gets added to the GDP. If you take a look at the Chinese GDP, the total GDP of China, anyways, is on an uptrend, is moving from those levels of 2% and 1% of COVID to almost 5% and upwards of 5%. But there is a big shift that is happening there as well. Chinese GDP was predominantly export led, which basically meant most of the stuff that they were manufacturing, they was exporting it to the rest of the world. Come Donald Trump, tariffs, a lot of hit has happened to exports. And if you see, the export contribution to GDP has come down significantly. But what has gone up significantly is consumption, because as Chinese came out of COVID, they started consuming. And a clear snapshot of that is probably visible here. I will explain you this chart. Don't get confused. It's a very simple chart and a very interesting chart to take a look, and then you will probably make sense of it by the time we're done with this chart. So what you have here is you have deposits. Deposits are basically money in the bank. So when we had COVID, our deposits or money in the bank went up because we couldn't go out and spend. We couldn't go out on holidays or restaurants. Who wanted to buy a new car? No one wanted to buy a new car. There was no need to buy a new car. There was no need to buy new clothes also. All we were spending on was household stuff and utilities, electricity, internet, all of that. Exactly the same thing happened in China. Because they were locked down for the longest period of time, their household deposits went through the roof. And look at this blue line. It is at its highest ever in China, which meant Chinese have now a lot of money locked into their bank accounts. But Chinese love real estate. They buy a lot of real estate. If you think Indians love real estate, you have to go to China to see how much they love real estate. So a lot of real estate led problems happened in China. Evergrande, if you would remember, was a real estate company that went down, and Chinese lost faith in real estate. And that is why people were not buying any new homes. So, what was happening was the loans were coming down. So, EMIs were going down, deposits were going up, and this big mismatch of money in the bank and less EMIs to pay is a big reason for Chinese to now start going out and consuming. And then COVID got lifted. And as they emerged out of COVID, if you take your mind back to COVID, the minute we realized, or my family realized, that COVID is out, I did 3 holidays back to back. I went out and my kids were shopping like crazy, like they've never been to a mall before. This is the last time they'll ever go to a mall. That was what, and I'm sure most of us were doing the same thing. We started going to restaurants thrice a week, and all of that started happening. Exactly the same thing is now happening in China, and that is causing this big boom in the Chinese economy, which is led by consumption. And when consumption leads an economy, the entire economy gets uplifted. Even people down below with low levels of income, they benefit the highest. And that is why we think this Chinese story now is a great story to invest, because this is at a back of big boom in consumption. And that's where, we think you should be diversifying from your India holdings or US holdings into China. So let me do a rerun on what we've covered so far. So two real good reasons. The world is expensive. Everything is super expensive right now. China is cheap, but cheap always is not good if it doesn't have growth. China has huge amount of growth, which is led by uh, big consumption boom happening. I will just show you one more slide to make this argument more compelling. Now look at this chart on the right hand side. What you see is this is the earnings of their main companies of different geographies. So you have earnings of US, Europe, Japan, APAC, and China. Now, what you will see here is look at the earnings in 2025 and look at the earnings estimate in 2026. This marginally positive in countries. Look at China from a negative earnings to a hugely positive earnings. So China is leading the earnings growth at about 14.5%. What that means is that Chinese companies which are still cheap with huge amount of earnings, if you invest in those businesses today, you will make a lot of money in the next 3 to 5 years. And that is why the story of China is very, very compelling. Now, you could turn around and say, hey, the story is very compelling. I am convinced and I want to invest in China. But why should we invest with the Edelweiss Greater China Fund? So let's just backtrack a little. Now, if you are an Indian citizen or you are an NRI, this fund was open in India, uh, which till about 2 years back, you could have invested in the mutual fund version of this product. But what's actually happened is there is a regulation in India which says mutual funds can only invest in offshore funds till about $7 billion. And that limit is over because everyone came in by the truckloads when they saw this tech-led rally of Nasdaq, and everyone invested in Nasdaq companies. We have a US technology fund which is doing very, very well, and everyone invested in that. So that limit is over. Now, to go out and diversify, you need to find another way. And the city route is a brilliant way to actually invest. And especially if you're an NRI, it's a phenomenal, phenomenal way to invest. And we'll get into the operational things in a bit. But that is where we said that, hey, why don't we replicate the fund in India, which is the Edelweiss Greater China Fund, which feeds into the JP Morgan Greater China Fund. And as you will know, JP Morgan is one of the premier, one of the globally well-respected asset managers who manage large amounts of money, and they have teams in local geographies. So JP Morgan's got a team in China, which sits in China and decides what companies to invest in, etc. So you actually end up investing in one of the into the best businesses in China. Now, having said that, what is the fund investing in? There are three main themes that the fund is investing in. The fund is investing in Chinese tech companies, Chinese companies that lead to renewable energy, carbon neutrality, and the big one, which is Chinese consumption. Now, we covered Chinese consumption, so I'm not going to spend too much time there. But let me spend a few minutes on the Chinese tech story. If you have followed the US tech companies, especially guys in the semiconductor business, guys like AMD, ASML, NVIDIA, a lot of these guys, what you will see is their stock price has soared. Why has that soared? Because a lot of them had a lot of supply that was required for us to put cloud infrastructure. Because as artificial intelligence started taking off, and now it's going into every periphery of technology, as we see, a lot of work was needed. A lot of semiconductors were needed to put into the cloud servers for computing. China, as you will know, US has put a ban on China for these high-end semiconductors that are being supplied by guys like TSMC, Intel, and NVIDIA. So Chinese had to manufacture their own semiconductors. So some of these companies like Foxconn or Wu, their s- their requirement or their demand for their semiconductors has just gone through the roof, and we think this will continue to move forward. The entire cloud server business in China is growing very, very rapidly, and these businesses will benefit out of that. The next big thing that's actually happening is China was till about some time back only making about 10% of their own semiconductors. Now China is making almost about 20, and this number will go to 30. So there's a big play of, you know, semiconductor requirement within China. And if you've seen Nvidia and AMD stock prices, some of these companies will replicate the same. The second big thing is carbon neutrality. And this is where, it's very interesting. You would be surprised to know that China is the biggest electric vehicle car market in the world. They consume more EVs than all the rest of the world put together. And this difference will continue to become larger and larger. And China's got their own version of Tesla by BYD and NIOS and companies like them. But what China also has, which US does not have, is the big electric vehicle battery manufacturer. So if you know what an EV is, what you will realize is the main component of an EV is actually it doesn't have an engine. It has a battery. Everything is in the battery. And the best battery companies in the world are actually in China. China's or the Apple equivalent in electric vehicle batteries is a company called Contemporary Emprex, which is a Chinese company. It every one in every two batteries that are sold in the world are actually made by Contemporary Emprex. So that business is booming. But also, if you think that climate change is an existential threat, which it is, we will have to rely more on renewable energy. And solar energy is leading the way into renewable energy. You'd be surprised to know that China has a 90% market share in global solar panels. So, all solar panels that get manufactured, China has 90% market share there. 9 out of 10 are supplied by China. And some of these companies like Mongolia, etc., are market leaders there. So, you get a chance through this portfolio to buy into these businesses as well. So that is why this entire case of investing in China for diversification at cheap valuations with growth in it into some of these very, very high growth cutting edge businesses makes China a great story to invest. And from that standpoint, we think, you should be looking at the Greater China Fund that we will be collecting money through Edelweiss and feeding to JP Morgan. That's the JP Morgan team. So what you will see is it's got a big team of portfolio managers and analysts. They're covering sectors across China from technology, which Edward Yen does, to consumption, to internet, to industrials, etc. So across China, a lot of these sectors are getting covered. Now,
So
you
Varun,
know,
we have a
yeah,
question. Sorry to interrupt.
go for
So
it.
one, just like we have to give an elevator pitch to summarize, what you have said so far is, just like how India, when it came out of COVID, the equity markets boomed, and it was led by consumption as well as high savings rate till then. So what I've understood is, while India came out of COVID, let's say in 21, 22, China is coming out of COVID now. So that represents, one opportunity. And then, like how US has a lot of deep tech as well as, some of the cutting edge technology. Same as, there's a similar case to be made for China as well. So, a similar growth can be expected. So that's that's my sort of understanding. But just to sort of flip the question and look at the risks, and maybe this is something that you will cover. And there's a question on chat as well from Mehak, and which is around, what are the structural risks? China is also infamous for a lot of, government intervention and, being the kind of, economic regime that exists there. it's at least to outsiders like us, it's not clear whether the government will let you make money or not. And I think you are the right person to answer this question because you've been part of the team at JP Morgan who launched this fund back in 2009. So you have seen the entire China story for almost 15, 16 years now. So what has been your experience so far? Is this is the regulatory risk justified? Has it mitigated over time? Is there a is change of stance there? Would love to hear your opinion on that.
What's happening in China is that, China as a country is very, very volatile because of obviously government intervention. And the government intervenes into a lot of private sector business. And because of that, China has always been volatile. So way back in 2014, we saw big regulation in terms of healthcare and industrial companies that they cannot pollute the rivers, they can't dump their waste into the rivers, and we saw Chinese stock market correct from there. And then we saw this big regulation come in 2020, 2018, where when the entire trade war started, the Chinese government said monopoly is not something that Chinese businesses will subscribe to. Some of the monopolistic businesses came down that time. And then recently we saw, Xi Jinping had this pat with Jack Ma of Alibaba. It started from there, and then a whole horde of regulations came in. Some of them were completely mindless, that education cannot be done for profit. Now, how do you get into business if you don't want to make money, right? But what's happened now is what they've understood clearly is that because of what they did, they disrupted the big growth that was happening in China. And they've taken a couple of steps back there. What's also happened is uh, Donald Trump has actually helped Chinese businesses in a very indirect way because as he came with a lot of tariffs onto China, the Chinese government became very protectionist of their own industry. And what they did was they started giving sops to the Chinese businessmen. And there were a lot of bank-led reforms. There were a lot of interest rate-led reforms. China, in fact, was the first country to start cutting rates. This is way before US started cutting rates. They at that point in time, if you remember 2 years back, you know, when Evergrande was happening, a lot of people said this is China's Lehman moment. And this will just spiral out of control, and Chinese companies will just fall by the wayside, especially the real estate companies, because Evergrande was a real estate company which had taken a lot of loans but could not pay back that loan. And a lot of Chinese had homes with Evergrande. So the Chinese government stepped in, said, we will complete all of these homes and give it to people. They bailed Evergrande out in a very meaningful way. They told HSBC, who was the largest lender to Evergrande, to give limits to Evergrande, and they put money on the table. So clearly, what's happening is the Chinese government has come far away from where they were 5, 6 years back. But having said that, there are three big risks that we see. The first risk is geopolitical, and you cannot mitigate that risk. You will not be able to change that risk because think about it, China is gunning to be the largest economy in the world. US is the largest economy in the world. US will not give away their position very easily. So there will be tussle and reverse tussle, and we will see a couple of decades of tussle before China eventually takes over and becomes the largest economy, which eventually it will. So that geopolitical risk will continue to happen. The second big risk, which is coming about, which is turning favorable for China, which is a lot of these countries, especially BRICS countries, Russia, India, and China and Brazil, are now saying that we will not trade in US dollars, and this big de-dollarization trade will happen. So when that trade starts happening, which it started now, and if people have read, recently the first payment gateway of BRICS was opened up, and uh, Chinese bought soya bean from Brazil, and India bought oil from Russia and Iran through the BRICS gateway. Now, what that does is then if you're using the BRICS gateway, you don't have to pay anything in US dollars and you don't have to go through US banks. And if you're skipping the entire US banking system, US cannot charge anything on that. And that is a big positive for China. So, what that will do is cause a little bit of disruption for the time being in global trade. But over a longer period of time, that's great for China. And finally, I think the big point that China is going through its own changes, which is China was a manufacturing-led economy. It is now changing over to becoming a consumption-led economy. And that is where some of the businesses will not do well. Fortunately, you have an actively managed fund, which we have, which is not focusing on manufacturing companies of China. It is not focusing on those guys who are making t-shirts for Nike or toys for Hamleys or any of that. The businesses that we are focused on in this fund, in fact, they are up on your screen, are these big tech companies of China. So some of them you will know. Alibaba, which is the Amazon equivalent, is the largest e-commerce platform of China, and Chinese buy hugely from here. Followed by something like Tencent. Tencent is the Facebook equivalent of China. So a lot of Chinese don't use American apps. So there's no Facebook in China. There is no Google in China. Google's version is Baidu, and Facebook's version is Tencent's WeChat. And they use WeChat Pay, which is the largest digital payment platform. And most of you would not know that every second mobile game that you have on your phone from Call of Duty onwards is all Tencent. So all of these games are mobile. Tencent is the largest mobile gaming company in the world. And finally, a TSMC, which is a Taiwanese company, it's a Taiwan semiconductor company, is the largest semiconductor company in the world. It has almost about 60% market share in the high-end semiconductor business. So a lot of that risk mitigation by buying an active portfolio is getting taken care of, Ankur.
Yep, got it. Thanks. Um, any other questions we can quickly take before we get into the operational aspects or around the new fund that is being launched in GIFT? Feel free to put it in the chat and I can take it up. Varun, we can move ahead with the presentation.
Sure. So I want to cover why we are saying that invest in China now. The points that we covered obviously make sense, but from a return standpoint, now look at this. Look at the chart, calendar year performance, and this one, the fund performance, the great JP Morgan Greater China. So I mentioned that there were regulations in 2014 because of which Chinese market did not do well in 2015 and 16. And after that, look at a bumper year that came through, 57% return. And then because of the 2018 regulations, 18 wasn't a great year and you had a great 19 and 20. And the recent regulations have had impact and you did not have great 21, 22, 23. You had a reasonable 24. You've had a good 25. And we think next 3-4 years will be super for Chinese equities. They're still cheap and they're growing very, very rapidly. So, that's so much on the fund. Moving to the operational part of the fund. So, what we will be doing here is we will be taking money from investors. If there are NRI investors, they can invest directly into the Gift City dollar account. And it's a very simple, Belong will take all your data and upload it and send it to us. And we will then provide you varied folio numbers and you can invest through that. And all the investments that you will have to make are going to be in US dollars. So you don't need to fund it from your India NRE NRO account. You can fund it from if you're in the US, you can fund it from the Citibank JP Morgan account. If you're in London, you can fund it through your Barclays account. If you're in the Middle East, you can fund it from your Middle Eastern bank account. Uh, you will have to make the payments in US dollars. And if you are in India, you will be using your LRS limit. And through your LRS limit, you can invest as much as 2.5 lakh dollars per financial year, and you can use that and invest. Uh, in terms of the minimum investment is $5,000. On top of that, you can have $500 worth of multiple subscriptions. The fund will invest in the underlying fund, which is the JP Morgan Greater China Fund, which is listed in Luxembourg. So the fund will invest there. And every time you need to redeem, you can place a redemption and the money will be in the bank in T plus 5 or 5 working days post your redemption date. So it's a very simple mechanism. All investments are digital. You don't need to have a physical form that you have to fill and courier anywhere or anything of that sort. It's all digital end to end. So fairly simple in terms of operational, efficiency.
So, Varun, a couple of questions on chat around this. Uh, First one is it open to US and Canada investors?
Unfortunately, Canadian investors cannot invest, but US investors can invest through reverse solicitation. So there is a form that they will fill and they will send that form out. So through that, they can invest.
Okay, got it. And Uh, can you also talk a little bit about taxation on this fund? Because I think in GIFT, there is a fund level taxation, which is
Correct.
something new for retail investors to understand. So, yeah, do explain that.
Sure. So if you were investing in the India fund or the India mutual fund of the version of this fund, what will happen is you will have to, once you redeem, so if you've invested 100 and your investment becomes 200, on that 100 dollars that you've made the gain, you will have to pay 15% tax, which is 12 and a half plus surcharge and all of that. So you will have to pay a 15% tax. Tax has to be paid by the investor in that India fund. But in case of this fund, because it is a category 3 AIF listed in Gift City, the fund will pay tax. So what we will be coming up with is going to be a post-tax NAV. So you will have two kind of taxation, long-term and short-term. If you redeem before 2 years, you will be subject to short-term taxation, which is the short-term NAV, which is about 40%. We highly recommend everyone to have at least a 3 to 5 year investment horizon. So if you redeem after the second year, you will be entitled to a long-term NAV. The long-term NAV is 15%, which the fund will deduct on your behalf, pay the tax on your behalf, and all the money that the investor gets in their bank account is completely tax-free in jurisdictions which don't charge a further tax. Countries like US and Europe, which charge a further tax, clients will have to pay whatever taxation is applicable in their home country. So that is how it functions.
Sorry, and just to clarify, um, even for even for resident Indians, once the fund has deducted the tax, there won't be any further tax, right?
No, they don't have to pay anything else once the fund has deducted the tax.
Got it. And is there any, as you said, that, one should have at least a 3 to 5 year horizon, which is, in general also is not specific to, a China strategy or anything. These are equity investments. So one should have a long-term horizon. But is there any lock-in or exit load around this?
Yes. So we have a 25 month we have a 25-month exit load, which is 1%. Now, which essentially is to deter people from redeeming before the 24-month period. We've kept 25 months that, there is one extra month just in case people get the calculation wrong and say that, hey, my 24 months are over today. and I want to redeem today and they miss it by 1 or 2 days here and there. We don't want, because of that wrong calculation of one day, people actually ending up paying 30% plus tax instead of 12.5%. So that is why there is a 25-month exit load of 1%. After the
Got it.
25th month, there is no load.
Got it. And just to clarify for everyone, see in India, the cutoff between short term and long term for Indian equities is 12 months, but for foreign equities, it is 24 months. So that is where this 24 months period is coming. Also, Varun, if you could share, what is the expense ratio of this new fund that will be launched?
So the expense ratio of this fund will be 1.5%, and the NAV will have all expenses deducted. So there is no other expense that will get deducted from the NAV. So NAV is all expense adjusted.
Got it. And essentially, Varun, for my understanding as well, as an investor, when I'm investing, right, you are investing this money. It is a feeder fund, right? So you're
Correct.
investing this money in the JP Morgan fund, and you're essentially holding those units on my behalf. There is no churn at the fund level as such, right? You're just
Yeah.
buying and holding it.
Yeah.
Any churn that happens is probably happening because of my redemption, and
Correct.
hence that post tax NAV is there. You will deduct the applicable tax at your end and then remit the rest to me. So is this broad understanding correct?
Absolutely correct. Absolutely correct.
Got it. Yeah, there's a question. The 1.5% that you mentioned, is it inclusive of the underlying funds, so the JP
So
Morgan funds
the
expense ratio?
underlying fund charges another 60 basis points, but that actually gets adjusted with the NAV that we get. So whatever NAV that we get, another 60 basis is not deducted. That is already adjusted by JP Morgan.
Got it. 60
And
basis points is 0.6%.
and the good thing is that if so an investor can always turn around and say, why can't I buy it directly in my geography? So if I'm in US and I find that the JP Morgan Greater China Fund is there, why can't I buy it directly there? I will encourage you to at least try buying it, because actually case there is that we are buying an institutional share class because we are supplying large sums of money to JP Morgan. If you were to go buy it as a retail investor, their charges are close to 5% in the US and other geographies. So you get it much cheaper here.
Got it. Got it. No, that's quite useful. And where did you say the fund was domiciled? This was a Luxembourg
This is a
domicile fund.
This is a Luxembourg fund.
Got it. And is it a sort of distribution oriented fund or a growth fund? Because that may have additional withholding tax.
So this is a growth fund domiciled in Luxembourg. It's an out and out growth fund. So just to make investors aware on the journey of how the money will move. So say, for example, you're an Indian investor, or even if you're an NRI, you will give money to the Edelweiss Greater China Fund, which is in GIFT. The money will come through LRS, or for NRIs through the OPI route, and we will get the money in US dollars here. If you give it to us in INR, we will convert it to US dollars. Now, once that happens, we will supply the US dollars to JP Morgan, and they will give us the units of this underlying fund. JP Morgan in turn will go and buy equities of different companies in China, Hong Kong, and Taiwan in their respective currencies. So yuan in case of China, Hong Kong dollar, and Taiwanese dollar in terms of Hong Kong and Taiwan. And when the redemption is placed, this similar process is followed. JP Morgan will sell some of these stocks, they will get their money, they will remit the money to us, and we will remit the money to the investor. So same process flow.
Got it. Just seeing there some more questions. So Chetan's asking, if investment happens in any other geography apart from China, like Taiwan or Japan?
So, Chetan, it happens in China, Hong Kong, and Taiwan. And just for your information and understanding, a lot of large uh, Chinese companies are actually listed in Hong Kong. So somebody like a Tencent is actually listed on the Hong Kong Stock Exchange. Hong Kong, you will know, is a territory of China. So it's not a different country, it's a territory of China, which has its own stock exchange called the Hang Seng. So Tencent, Alibaba, Pinduoduo, which is a 2.94% holding. It is another e-commerce platform. So Alibaba is like the Amazon, and Pinduoduo is like Flipkart. So it's a lot of these guys are or NetEase. A lot of these guys are listed in Hong Kong. Chinese companies listed in Hong Kong. A lot of Chinese companies, China Merchant Bank, for example, is listed in China. And TSMC, which is the Taiwanese semiconductor company, is listed in Taiwan. So across these three geographies, uh, what is the breakup? The breakup is 60% of these are in China, about 31% are in Taiwan, and 2.4% are in Hong Kong.
And another question, Varun, in the underlying fund, the JP Morgan fund, like, do you have a sense of, where most of the capital has come from? Like, what is the distribution of that AUM?
Predominantly Southeast Asia, because China is a home market for a lot of Southeast Asian countries, Malaysia, Indonesia, a lot of them, Singapore, uh, and Hong Kong. Hong Kong is a big market, so a lot of money's come through from a lot of these geographies.
Okay,
But,
another,
but
yeah.
the Indian fund that we raised, which we cannot take any more money in, is a strategy where we have almost close to 2,000 crores of Indian capital, which is almost about $2.2 billion. dollars.
Yeah, no, actually, yeah, that's quite interesting, the growth of the Indian mutual fund. And I think based on that demand is, why you have launched the gift version of this. Uh, there's another question, again, just clarifying on the tax bit, that the tax that we have spoken about is applicable to both resident and non-resident Indians, right?
That's correct. There is no discrimination because in this case, what happens is the fund is paying the tax and the fund is domiciled in gift. So the fund is applicable to gift taxation.
Right. So again, just to clarify, like in the previous episodes, we have discussed, inbound funds where there is no tax. So, for the audience, the tax exemption given by the Indian government is predominantly, or actually, only for funds investing in India, right? They want to attract foreign capital into India, and hence that exemption has been given. There is no tax exemption for outbound funds. So the same taxation applies for non-resident as well as resident Indians, for an outbound fund via gift. Harsh is asking, is it a direct fund or regular fund? So it will be available in both variants. And there's one question I had. So the underlying fund is a USD denominated fund, right? So now a resident Indian, when it was investing in the India domiciled fund, which was INR denominated, versus now this fund, which is USD denominated. So especially for NRIs who hold USD, that is one less conversion, right? So is that going to benefit in some way, or it comes out in the wash?
To them, nothing. But if you are investing, if you're an Indian resident and you're investing through your India account, then dollar appreciation will give you additional gains. So if the dollar appreciates by for somebody who's investing in US dollar and the investment happens in US dollar, nothing changes. The world's a beautiful place. But for Indians who are investing in INR, if the fund gives you a 12% return and the dollar appreciates by 3%, your return is 12 plus 3, which is 15.
Got it. There's another question that, in case there is a lot of global uncertainty around China, is there a carve out in the fund to, decrease its exposure to China and maybe just sit in cash or allocate to some other geography?
No, that provision is not there. So what will actually happen is the investment team might probably take a call of increasing the allocation to Taiwan. But in all cases, historically, what we've seen is the maximum allocation that has gone to Taiwan is about 40%. So 60% still stays in China.
Got it. Yeah, I mean, you have to stay true to the fund's objective because that's
Correct.
what why people have given you the money. Another question, I think this is something we covered earlier when we started the session, but uh, just to reinforce. On chat, Mehak has asked that for an Indian investor, right? Like, why should they consider investing in the Gift City version versus the MF version in India?
So, Mac, the MF version of India is shut for subscription. So you can maximum do 5,000 rupee of SIP in that per month because we have in India, there is a limit of $7 billion that mutual funds are allowed to invest in offshore funds. Now, those limits are over. Not just for us, most asset managers, those limits are over. Uh, Fraction of the limits are left, which we've kept for SIP investors because already these funds had SIPs running. So, not to close those SIPs, we've kept those SIPs up and running. And that is why nobody's taking fresh subscription in the India fund. And that is why we give you an alternative to invest through the Gift City fund.
Got it. And there's a fund level cap also, right? Or AMC level cap of $1 billion, right?
So there is an AMC level cap, there is a industry level cap of 7 billion, AMC level is 1 billion.
Got it. And all these limits have been exhausted
Everything,
for some
everything.
time.
So if you see all big funds, small funds still have small minuscule limits which will get capped very soon. But most large funds for example, Motilal Oswal or us or Franklin Templeton or ICICI Prudential, all of them are shut.
Got it. Got it. Abhimanyu has a okay. Doesn't the cap reset in new financial year? So yeah, this is actually a question I also came across recently. This is not a per year cap, so it's not like LRS where there is a per year. This is a cumulative cap. It does not reset in a new financial year. It's not like we can have fresh $1 billion or $7 billion of investment each year. This is a cumulative, industry-wide cap that once hit does not reset. Another question, on chat from Abhimanyu is, and part of it we covered, but again, so for the resident Indian, the case from GIFT is pretty strong. What is the case for, let's say, a non-resident living in US, UK, UAE to go via the GIFT route for this fund? So you touched upon the US bit, but if you could just, cover that again.
Sure. So if you're living in jurisdiction outside of India, the fund will anyways pay the tax and the client will get or the investor will get tax-free returns in their hand. Now, uh, what will happen is when the money is getting remitted, the local jurisdiction tax will kick in. So in case of UAE, there is no tax. So they will end up paying no tax. In case of Europe, different countries have different taxes. So whatever slab you land up in, you have to pay there. In case of US, again, the tax will get triggered in that you have to pay your federal tax plus state tax of on equities and end up paying that. So that is a country level, country specific thing. India is trying to make it as simple as possible, but the other countries have to go with that as well. So, for that reason, residents of or NRIs of US and UK or Europe will have to pay additional tax. UAE, nothing, nothing more.
Got it. And you also mentioned trying to access the underlying fund directly will be more expensive at the retail level.
Far more expensive, and it's not and a lot of geographies the fund is not present. So UAE, for example, doesn't have this fund. So a UAE resident can't say that, hey, I'll log into some of my platforms and I can buy it from there. There's no way to buy it.
Got it. Um, Okay, another question is how about taxation for Singapore residents? So it's pretty much the same fund level taxation. And beyond that, there's no tax because Singapore also, I don't think, has any capital gains tax.
Yeah.
Okay, while we have some more, we'll wait for some more questions, but I had a couple of questions for you, Varun. In general, because a lot of global Indians, whether NRIs or resident Indians, are looking to diversify globally, right? In fact, this was one of the top financial goals. We recently did a survey in our community, so this came out as one of the top financial goals that they want to diversify their global exposure. So I wanted to ask you, as a investor yourself, as as what is your global allocation strategy? How much is India, how much is US, how much would be China, and how do you look at global diversification?
So my portfolio is, and you'd be quite surprised when I tell you this, Ankur, my portfolio is 60% outside of India. So I just have 40% to Indian equities. I have almost 60% outside, of which the lion's share is of that 60%, about 35% to 40% now because of mark to market is in US. And US, I invest only in US tech companies. I was clear from the word go that if I have to invest in banks, an HDFC bank or an ICICI bank will outpace a JP Morgan or Citibank any day. If I have to buy consumption companies, Asia is the place where consumption is going up, not the US. If I have to buy manufacturing, US is not the place. But if I have to buy technology, US is the place to buy tech companies. And that is why my portfolio is highly skewed towards American tech companies through our US technology fund, the Edelweiss US Technology Fund, or NASDAQ. The second big allocation is China. I'm almost 15% of my portfolio is in China, and I'm a very strong believer in the Chinese growth story. And of the rest of 10%, 5% is in Europe and 5% is in Japan.
Got it, got it. And for, let's say, someone who is starting to diversify, their portfolio uh, geographically, right? Let's say I have everything in, for just hypothetically saying, let's say all my allocation till now is India, right? How should I go about, like, what's a good starting point, for geographical diversification?
I would say, I would say if you would have asked me this question 3 years back, my answer would have been start with US. But now, the US rally has played out quite a lot. And if you go big lump sum into US, it might not be the best place to put a lump sum. Uh, Please invest in US, but through a systematic way. Invest something every month at these valuations in the US. Hard to say how long these valuations will sustain. So invest, but do not ignore US tech companies. They are consistent compounders, and this is the next 20 years is a tech-led rally. Uh, so please do invest in US tech companies, but systematically invest. China is where lump sums can be made, and the Chinese tech rally hasn't even started. In fact, I came across some data, the equivalents of China versus US valuation. So Amazon is trading at a 40 multiple. Alibaba is trading at a 20 multiple. A multiple means how expensive or how cheap you're buying. Higher the multiple, the more expensive it is. So if earnings are same for two companies, then you have to see what is the price that you are paying. So if, for example, I am going to buy a bag and two bags are same in terms of material, brand, etc., etc., one bag is priced at say 20,000 and the other bag is priced at 40,000. I might as well buy the cheaper one because I'm getting everything that I need in the cheaper bag, right? So exactly the same logic. Amazon is trading at a 40 multiple, much expensive compared to Alibaba, which is close to a 20 multiple. And Nvidia is trading at a 100 plus multiple, but some of these Chinese semiconductor companies are trading at a 15 multiple. So you're getting much cheaper. And chances of going wrong when you're getting something cheaper are quite slim. So if you're doing lump sum, please do lump sum in China. Another big place to do lump sum is probably emerging markets. Some of those emerging markets, nothing has happened. Countries like Brazil, etc., nothing much has happened. They've had small 6 month, 1 year rally, but the rally's got legs. Uh, Europe, I would probably say if you would have not invested, stay away because the underlying demographics of Europe have completely changed. There's not real growth there right now. Uh, it was a great buy 2 years back where Europe was extremely cheap, cheaper than China, but now it's not cheap anymore. And Japan, we think, for investors who are highly evolved, that is where Japan comes in, but it should not be the first of your three, four investments into offshore products.
Got it. Another question, can trusts and family offices also invest in this fund?
Absolutely, they can. There is a little more requirement of documentation, but they can definitely invest in these funds.
Got it. Yeah, I think those were most of the questions that we had. So now currently for this gift fund, uh, you've just launched, so currently it's in the new fund offer phase, right? And like we have started accepting money. So can you share some details about how long you expect the NFO to continue? When will the fund be available for, let's say, ongoing subscriptions?
So we think by the end of January, we will start new subscriptions. So you have a 30-day period for you to buy during the NFO period. And from then, the investments will happen on an ongoing basis. It is an open-ended fund, so you can come in anytime. You can exit anytime, provided you clear 2 years, you won't be charged any exit load. If you don't, then there's a 1% load.
Got it. And any plans for any other fund offerings from Edelweiss in Gift City?
We have filed for the US Tech Fund, waiting for the regulator to approve it. And we are preparing for another great idea. We're introspecting on what's another good idea to work with from a long-term standpoint.
Got it. Got it. Thank you so much, Varun. This was very informative. Learned, a few things that I didn't know about China. And yeah, looking forward to, seeing, this fund being live. I think it should be available on the Belong app now. So for all NRIs who want to check out this fund, you can do that on the Belong app. We will also start onboarding resident Indians in a month or so. So after that, even resident Indians should be able to invest in the fund. And yeah, thank you everyone for joining here towards the end of the year. That too on a weekend. Thank you. And if you have any further questions, we have a community, very active community around global investment, so we can continue the conversation there. And if you have any questions for Varun, I can pass it along and maybe get him back here, in a few months. So thank you everyone, and have a great new year.
See you guys.
Thanks,
Bye-bye.
thanks, Varun.
Bye.